Alright, let's get right into it. What if I told you that there's a secret system the wealthy use to make their money grow even while they sleep? What if I told you this system isn't really a secret at all, and you could start using it today, right now, with as little as the cost of a few cups of coffee? Most people think building wealth is about getting a huge promotion, starting a revolutionary company, winning the lottery. But the truth is, for the vast majority of millionaires, it's something much quieter, much simpler, and far more achievable. It's a strategy that relies on consistency, not genius, and it's available to absolutely everyone. The single biggest financial mistake people make isn't buying expensive lattes or indulging in avocado toast. It's believing that investing is a game reserved for Wall Street sharks in fancy suits or tech billionaires with money to burn. They see the stock market as a casino where you're guaranteed to lose. This belief is what keeps most people trapped in a cycle of working for their money instead of having their money work for them. Let's talk about your savings account. You put your money in there. You see the balance go up when you deposit more. It feels safe, right? The bank even gives you a tiny bit of interest. Maybe 0.1% if you're lucky. It feels like you're doing the responsible thing. But here's the harsh truth banks don't advertise on shiny brochures. Your savings account is most likely a leaky bucket. Every single year, your savings quietly lose buying power. You might not even notice until it's too late. It's a silent wealth killer. The culprit? Inflation. Think of inflation as the opposite of a discount. Prices slowly creep up. The coffee that cost you $3 last year might cost $3.10 this year. If inflation is running at, say, 3% per year, it means your $100 will only buy $97 worth of stuff next year. Your savings account, with its measly 0.1% interest rate, isn't even coming close to keeping up. You're effectively losing 2.9% of your money's value every single year. This is why just saving your money is no longer enough to build wealth or even to prepare for retirement. You're fighting inflation with a water pistol in a firefight. You're on a financial treadmill with the speed increasing. You have to run faster just to stay in the same place. Investing is how you get off the treadmill. It's the only reliable way to grow your money at a rate that not only beats inflation, but also builds significant wealth on top of it. It's the difference between your money slowly evaporating and your money actively growing. So the goal isn't just to save money. The goal is to grow your money. You work hard for every dollar you earn. It's essential to put that money to work just as hard for you. Leaving it in a low-interest savings account is like having a star employee on your team and telling them to just sit in the corner and do nothing. You're wasting its potential. To truly secure your financial future, to afford a house, to retire comfortably, to have freedom, you need to move from being just a saver to becoming an investor. So, what is investing, really? Let's strip away all the complicated terms. At its core, investing is simply the act of using your money to buy something that you believe will be worth more in the future. It's about turning your money into an asset that can generate more money for you. Instead of trading your time for a paycheck, ask your money to go out into the world and earn its own paycheck. It's like planting a tree. Start with a small seed, your initial investment. With time and patience, it grows and provides fruit, your returns. Think about it this way. At a job, you are the one generating income. You clock in, you do your tasks, you get paid. If you stop working, the money stops coming in. When you invest, you're hiring your dollars to work for you. You buy a tiny piece of a successful company. As the company grows and profits, your piece becomes more valuable. You don't manage daily operations, but you get to share in its success. Your money is on the clock 24/7, even when sleeping, on vacation, watching TV. When you're ready to start investing, you'll find there are countless options, which can be overwhelming. But for most beginners, it really boils down to 4 main categories: stocks, bonds, mutual funds, real estate. When you buy a stock, you're buying a small piece of ownership in a single company. If stocks are like owning a piece of the company, bonds are like lending money to the company or a government. A mutual fund solves this problem. It's a big pot of money collected from many different investors. Investing in real estate means buying property with the goal of it increasing in value or generating rental income. Albert Einstein is often quoted as saying that compound interest is the eighth wonder of the world. It's just interest earning interest. Your money starts making babies, and then those babies grow up and start making their own babies. It's a snowball effect for your money. Imagine you invest $1,000 and it earns a 10% return in the first year. At the end of the year, you'll have your original $1,000 plus $100 in earnings, for a total of $1,100. Now here's where the magic happens. In the second year, you're not earning 10% on your original $1,000 anymore. You're earning 10% on the new total of $1,100. So your return in the second year is $110, not just $100. The real power of compounding doesn't show up in the first few years. It explodes in the later years. Person A starts investing $100 a month at age 25. Person B waits until age 35 and starts investing $200 a month. Person A ends up with over $349,000. Person B ends up with only about $275,000. Time is the most valuable asset you have as an investor. In the world of investing, there's a fundamental principle you absolutely need to understand. It's the relationship between risk and reward. Simply put, higher potential returns mean higher risk. There's no such thing as a guaranteed high return with zero risk. If someone offers that, run. Stocks are generally on the higher end of the risk-reward spectrum. A single stock could double, could even triple. But if the company performs poorly, your investment could drop a lot. If it goes bankrupt, it could go to zero. Bonds are on the lower end of the risk-reward scale. As a lender, your return is capped. Mutual funds sit in the middle depending on type. A broad market index fund holds hundreds of stocks, spreading risk. Real estate can return value through appreciation and rental income, but has risks like property damage, vacancies, or market downturns. Okay, so you're convinced. Investing is important. You understand the basics. Now for the most important part. How do you actually get started? Especially if you don't have a pile of cash sitting around? The great news? Technology has made it easier and cheaper than ever. Gone are the days of calling a fancy stockbroker and needing thousands to open an account. Today, you can start investing from your smartphone with as little as $1. The barrier to entry has been completely obliterated. The very first step? Open a brokerage account. Think of a brokerage account as an account that lets you buy and sell investments. There are many user-friendly apps and websites. Fidelity, Vanguard, Charles Schwab, Robinhood, M1 Finance. Most of these have no account minimums. Open an account for free and start with what you have. Sign up is usually quick and can be done online in about 15 minutes. Once your account is open and you've linked your bank, you can start investing. But what should you buy? For 99% of beginners, buy a low-cost, broad market index fund. An S&P 500 index fund is a perfect example. By buying one thing, you're investing in the 500 largest U.S. companies. You get immediate diversification. It's like ordering the combo meal instead of picking individual menu items. The key is automatic and consistent investing. Set up an automatic transfer from your bank to your brokerage. It could be $5, $25, or $100, whatever you can afford. This strategy is called dollar cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer shares when prices are high. This removes emotion and builds a disciplined investing habit for life. Making your money work for you. There's an old saying that you've probably heard a million times. Don't put all your eggs in one basket. In the world of investing, this isn't just a quaint piece of advice. It's one of the most important rules for managing risk and building sustainable wealth. This principle is called diversification. It simply means spreading your investments across many different assets so that the poor performance of any single investment doesn't wreck your entire portfolio. Let's imagine you saved up $1,000 and decided to invest it all in one single company's stock. Let's call it Super Awesome Gadget Company. If that company invents the next big thing and its stock goes to the moon, you'll make a fortune. You'll be a genius. But what if their main factory burns down? Or a competitor releases a better gadget? Or the company's stock price plummets by 90%? Now your $1,000 investment is worth only $100. You've suffered a catastrophic loss. Now let's look at a diversified approach. Instead of putting your $1,000 into just one company, you decide to invest in an S&P 500 index fund. With that single purchase, your $1,000 is now spread across 500 of the largest and most stable companies in the United States. You own a tiny piece of Apple, you own a tiny piece of Microsoft, you own a tiny piece of Amazon, and 497 others. Now, if one of those companies has a terrible year, it has a very small impact on your overall portfolio. The success of the other 499 companies helps to balance out the failure of the one. If there's one final lesson to take away from all of this, it's that investing is a marathon, not a sprint. The stories you see on the news about people getting rich overnight on some hot new stock are the exceptions, not the rule. For every one of those lottery ticket winners, there are thousands of people who lost their shirts chasing quick profits. True, sustainable wealth is built slowly, patiently, consistently over many years. It's boring, and that's exactly why it works so well. The most successful investors are the ones who can ignore the noise and stick to their plan. The stock market will have good years and bad years. It will go up and go down. This is completely normal. There will be times when your portfolio value drops and it will be tempting to panic and sell everything. This is almost always the worst thing you can do. Your job as a long-term investor is to remain calm and carry on. Remember that you are buying pieces of real businesses, and over the long run, great businesses tend to grow and become more valuable. The market has always recovered from every single downturn in history and gone on to reach new highs. Patience is your superpower. So here is the secret formula, the entire game plan laid out for you. Step 1. Open a low-cost brokerage account. Step 2. Set up an automatic deposit for an amount you can comfortably afford each and every month. Step 3. Use that money to automatically buy a diversified, low-cost index fund. Step 4. Do absolutely nothing else for the next 30 to 40 years. That's it. That is the entire strategy. It's simple, it's effective, and it requires almost none of your time or mental energy once it's set up. The power to change your financial future is in your hands, right now. You don't need to be rich, you don't need to be a genius, and you don't need to have a degree in finance.